Understanding how the World Bank finances its mission offers a window into the intricate world of global development and international finance. The World Bank is not a charitable foundation simply handing out grants, nor is it a traditional commercial bank focused on personal savings and loans. Instead, it plays the role of a financial intermediary at a grand scale, transforming investments from around the world into lifelines for developing economies. Let's unravel the journey of money through the World Bank system, examine the key mechanisms of how it borrows and lends, and illuminate the cycle that underpins countless development projects globally. The story begins with the World Bank's need for capital, vast sums required to support the economic development of countries striving to combat poverty and build their future. The World Bank does not rely exclusively on a static pool of money from its member nations. Instead, it leverages the trust and confidence it commands in international financial markets, chiefly by issuing bonds. These are not just any bonds, but World Bank bonds, renowned for their safety, stability, and reliability. The investors who buy these bonds are varied: pension funds seeking to safeguard their clients' futures, sovereign wealth funds managed by governments, insurance companies responsible for decades-long obligations, and large corporations managing their excess cash in secure investments. The appeal of World Bank bonds is deeply tied to the institution's formidable credit standing. Holding a COA credit rating, the highest possible, signals to investors that the World Bank is among the safest entities in which to invest. This top-tier rating is a mark of stability, based on the bank's prudent financial management and the backing of its member countries, which include most of the world's strong economies. When an investor purchases a World Bank bond, they are essentially loaning money to the institution, and in return they receive a promise, periodic interest payments, and the assurance that, at maturity, the invested principal will be returned in full. This arrangement is attractive to risk-averse investors, confident in the World Bank's record of reliable repayments. Once the World Bank has raised money by selling these bonds, drawing on the collective trust of global investors, it applies this capital to make loans. But these are not blanket loans to anyone who asks. The primary mission is to facilitate tangible improvements in developing nations. The creation of vital infrastructure, enhancement of social services, and the nurturing of sustainable growth. From schools and health clinics to roads, power grids, and water supply systems, World Bank funding is meant to catalyze projects that lift societies and open doors to opportunity. The way in which loans are distributed within the World Bank framework is determined by its structure. The institution actually comprises two main lending arms: the International Bank for Reconstruction and Development, IBRD, and the International Development Association, IDA. Both play crucial but distinct roles, each tailored to the specific needs and capacities of the countries they serve. The IBRD is the original branch created in the aftermath of World War II, established to aid Europe's reconstruction, and now tasked with supporting middle-income and creditworthy low-income countries. These are nations that, while not among the poorest, still face significant development challenges and may not have easy access to affordable credit from commercial markets. The IBRD offers these countries loans on favorable terms. Interest rates, while linked to global markets, are kept lower due to the bank's ability to borrow money cheaply thanks to its strong credit rating. Furthermore, these loans feature long repayment periods, making them manageable for countries over the course of decades rather than years. On the other hand, the IDA was established to reach those countries most in need, where earning capacity is limited and poverty is most entrenched. For these nations, the world's poorest, even low-interest loans can prove burdensome. The IDA, therefore, provides what are effectively interest-free loans, often with grace periods that delay repayment and repayment terms that stretch for decades. In many cases, the support comes in the form of outright grants, where the funds do not need to be repaid at all. The money that fuels the IDA does not come from the bank's bond issues, but from direct contributions or donations from the world's wealthier nations. This ensures that resources flow to the most vulnerable countries without placing unsustainable financial obligations on their governments. Through these dual financial streams, bonds for the IBRD and donor contributions for the IDA, the World Bank structures its lending to meet the varied realities of developing countries. It is a carefully balanced mechanism designed not only to address immediate needs, but also to build a path towards self-sustaining growth and resilience. The lending process itself is meticulously crafted. Countries seeking World Bank loans cannot use them for everyday expenses or to fill general budget gaps. Funding is tied to specific projects: an irrigation system that promises greater food security, a modernized port that enables access to global trade, a campaign to expand primary healthcare in underserved regions. Before money is lent, the World Bank works closely with the borrowing country to design a project that addresses clear needs, assesses environmental and social impact, and includes robust oversight mechanisms. This rigorous approach is intended to ensure that money is spent effectively and the benefits are widely felt. Once a project is approved, the World Bank disperses funds in phases as the work progresses. Technical experts and auditors review the use of money, flagging potential issues and recommending course corrections as needed. As projects reach completion and begin to deliver results, more children in classrooms, safer roads, cleaner water, rising incomes, the borrowing country begins to repay the World Bank under the agreed terms. Over time, these repaid loans form part of the World Bank's revolving pool of capital, enabling further rounds of lending to new projects and countries. Meanwhile, the World Bank itself cannot stand still financially. It is responsible for regularly servicing the bonds it has issued, making interest payments to its investors, and, at maturity, returning their principal investments. The bank's rigorous financial management, combined with its record of timely payments and strong backing by member governments, underpins its ongoing AAA rating and ability to return to the markets for new bond issues. This entire system creates a continuous cycle of global finance dedicated to development. The World Bank raises capital not from handouts, but from the power of its reputation and the discipline of the international bond market. With this capital, it supports transformative projects in countries that need not only funding, but also expertise and accountability. The result is an ongoing flow of resources that helps close the gap between rich and poor, paves the way for economic prosperity, and responds flexibly to the needs of countries at very different stages of development. From a broader perspective, the World Bank's financial operations have ripple effects beyond the countries it directly supports. By mobilizing private investment through the bond market for development purposes, the bank demonstrates that the fight against poverty and underdevelopment is not solely the domain of charity. Rather, it is a matter of global risk-sharing, smart investment, and shared prosperity. Investors who purchase World Bank bonds are not donating money. They are making sound financial decisions while enabling the pursuit of global good. There is also a powerful lesson in systemic optimism here. The World Bank's ability to borrow cheaply and lend confidently relies on the collective belief, continually reaffirmed by its member countries, investors, and borrowers, that developmental progress is possible, that sound management yields results, and that cooperative international action can change lives. Every successful project, every timely loan repayment, every satisfied bondholder reinforces this belief, fueling the cycle for future generations. In summary, the financial model of the World Bank is a testament to the power of innovative global cooperation. Capital is raised through the disciplined, competitive bond markets, anchored by trust in the bank's financial stewardship and the backing of its international members. This capital is channeled through carefully constructed loans and grants to support critical projects in developing nations, always with a focus on results, transparency, and long-term sustainability. As countries repay their loans, the World Bank honors its commitments to investors, and the cycle begins anew, sustaining a dynamic engine for development. The next time you read about a new school opening its doors in a remote village, a road cutting travel time between isolated regions, or a vaccination campaign reaching millions, there's a good chance that the World Bank's intricate borrowing and lending system is quietly at work in the background. Through prudent borrowing, responsible lending, and a relentless focus on development, the World Bank stands as a unique and indispensable force in the quest for a more just, more prosperous world.